relevant year of assessment is also clearly and specifically mentioned. The mere fact that his PAN number is not mentioned at all, or a wrong PAN number has been given, is neither here nor there, and I don't think that would at all operate or result in the reasons recorded on the reopening being vitiated and rendered bad in law. Now, having said that, if therefore the reopening is valid without mentioning a PAN number, then even if there is an incorrect PAN number, then even if that incorrect PAN number is never rectified afterwards, but the assessee is capable of being identified clearly and without any doubt on the basis of his name, particulars, address, etc., nature of the business, year of assessment, then the fact that the error in giving the PAN number is not rectified, or the fact that it is rectified after the expiry of the 6-year period, according to me, would not make any difference at all. And I don't think that circumstance can at all be relied upon as a ground for contending that the reassessment proceedings are bad.
Next question for Pradip by 23. 141 after 148, 143 to here.
The sum and substance of this query is that there is a case of reassessment in which, while passing the reassessment order, before that a notice under 143(2) was not issued. Several decisions relying on Supreme Court's decision in Blue Moon's case, in the context of which was in the context of Chapter 14B, in the context of 147, have taken a view that it was a necessity to have issued 143(2). Without that, the assessment would be invalid. The related issue is, this was a case in which 142(1) notice was issued, but 143(2) was not issued. So the revenue's argument is, would it not be a sufficient compliance? The answer to that is that 142(1), the objective of 142(1), if you read it carefully, is apparently different than 143(2). 142(1), I would believe, is not mandatory, while 143(2) is mandatory. So having issued 142(1), non-issuing 143(2) cannot stand cured. So that is another crime. The third is, this was a case wherein the assessee had cooperated in reassessment. So was it therefore be cured by 292BB? 292BB is a provision which says that if you have cooperated and if you have not objected, several things will be deemed to have been complied with. Now if you would read 292BB, you would appreciate that what is cured by cooperation is the non-service of notice. But non-issue of a notice cannot be cured by 292B. This is another view which one would be. The third thing is, can I contend it in the appeal, though I have cooperated in the proceedings, by saying that notice was never issued. The AO himself admits that notice was not issued. The Act 292BB therefore could not have cured it. And can an appellate commissioner states that, look here, if you should have said that during the course of reassessment itself, I would take a view that this goes to the root of the reassessment itself. It challenges the validity of reassessment, and therefore it would be legal for you to challenge a violation of law in the appellate proceedings, which could be taken up even at the tribunal level also. Yeah. And there is one more thing, is something on which, perhaps we'll have to collectively decide is, that this is a case wherein the AO understood that, his entire reassessment which has been framed by him is not valid on account of technical defects, not on account of not having any good reason, not on account of there being an escapement of income, but on account of a technical default of not having issued a notice under section 143(2). The answer here is that having once got into a reassessment which is invalidated by the appellate authority, assuming that the time permits him to issue another notice under 148, could he do so or not? As I read the law, there is no express prohibition on, unless, for the same reason, if the reassessment has been invalidated. This is a case wherein, for technical reasons, the reassessment was scrapped. And if you are otherwise well within the time, is it not that the AO is permitted to once again issue 148 for the same reasons, which reasons are otherwise acceptable to be valid. I would believe that, we all should request Mr. Ganesh, to share his views on this aspect alone, and that 2 minutes which he will share would be very, very useful. Okay, very well. Then thereafter, later on we will go to that. Yes, go ahead. Yes.
Next again, 24.
TDS question? Yeah, TDS is a simple issue. There is now an amendment, whereunder if a non-resident files a return of income or furnishes certain details that 206AA would not bother him. As regards DTAA is concerned, DTAA will always prevail and the rate in DTAA would prevail. There is another aspect to that which is not a part of this, is that there is a decision of Mr. Sayal who has held that, that when the tax is deducted at a flat rate which is prescribed under section 206AA, there would not be any need to collect surcharge and education cess. I would believe that is a correct decision because there is no parallel amendment which has been made in the respective finance laws. Thank you, sir.
Yeah. Next question, 25 for Mr. Ganesh. Agreement in 2002, possession in 2004, registration also. In 2006, he purchases, whether he had to do it.
The facts which are set out in question number 25 are remarkably similar to the facts of the case of Sanjeev Lal, which was decided by the Supreme Court in 2014 and which is reported in 365 ITR 389. Now the facts there were a little extraordinary. First, there was an agreement of sale which was entered into. The earnest money was recovered by the seller, and he thereafter proceeded to purchase another property. And at a point of time when the transfer of the property had not been completed, after he had purchased the new property, he then executed the conveyance and got it registered and completed the sale of the property in respect of which he had entered into the agreement earlier. So the question was whether he was entitled to the benefit of section 54, exemption under section 54, which was denied to him on the ground that he had purchased the new house more than 1 year prior to the date on which he finally executed the conveyance, selling his old house. And the Supreme Court laid down a somewhat extraordinary proposition only because it felt that somehow it had to give him the benefit of reinvestment, because in spirit, if not strictly according to the letter, he had satisfied the requirement of section 54. Therefore, the Supreme Court said that the definition of transfer in section 2 subsection 47, it includes extinguishment of any interest in the property. And it laid down that when a person enters into an agreement of sale in respect of property, there is an extinguishment of his interest in that property to some limited extent at least, because thereafter he cannot sell that property to anybody else. And therefore the Supreme Court came to the conclusion that the entering into of an agreement of sale would itself constitute a transfer of that property within the meaning of section 2 subsection 47. And therefore, if the new property is purchased within 1 year from the date of that agreement, then the requirement of section 54 is complied with. Now, I have carefully considered the judgment in Sanjeev Lal, and I would think it stands on its own facts and it really decides the very specific and narrow question of law which was put to the Supreme Court in that case. And I don't think we can at all draw the general conclusion that a transfer of immovable property can be said to be completed the moment an agreement of sale is entered into. And you do not have to wait till the final conveyance is executed for the purpose of complying with sections 54, 54F, etc. If this view is not taken, then I think there will be complete chaos. Because when an agreement of sale is entered into, ordinarily only a small percentage of the sale price is realized. If the 1 year starts ticking from that date onwards, and if the execution of the conveyance is for any reason delayed thereafter, then the seller may not have received the money out of which he could then go and purchase a new property and claim the benefit of section 54. And I would also look at it from another practical angle. If you enter into an agreement of sale, yes, perhaps to some tiny extent, your interest in the property is extinguished. Even that is a moot point, But whatever the Supreme Court says is supreme, and therefore we cannot doubt that. But then, that is not the sum total of the interest you have in the property. The consideration which you get is for transferring the property, allowing use, granting possession, enjoyment of the property, all of which is not given at the time when you enter into the agreement of sale. So therefore, at the highest, there is a transfer, and the consideration attributable only to that limited transfer would really come in. Now the Supreme Court has not gone into all this. Therefore, I would only think that they have given a very extended, liberal and benevolent interpretation for the purpose of section 54, so that an additional option is given to the assessor. So this does not at all mean that he necessarily has to make his reinvestment within 1 year from the date on which he enters into the sale agreement. It is always open to him to wait till the conveyance is executed, till he gets the complete consideration in hand, and then make the reinvestment within the prescribed period after the date the transfer is completed. Any other interpretation or reading, either of the judgment or of the provisions of the Act, would result in complete chaos and mayhem and gross injustice being done to assessors.
Last question, Pradip bhai.
There are two parts to this question. Fundamentally, the issue is about section 50 and inherited assets. In this case, a legal heir inherits office premises and factory premises. Office premises, his father had used it for the purpose of business and had claimed depreciation. He had also, after receiving the legacy, the legal heir had used it for the purpose of business, but had failed to claim depreciation in respect of it. So in this context, this part A is seeking to examine an issue that can he, on sale of these premises for which he had not claimed depreciation, which are inherited premises, when he transfers it, can he acquire another office premises so that the capital gains could be adjusted within the block of asset of section 50. Now if you would see, that as far as a legal heir is concerned, the provisions of section 50 by itself would not apply unless a legal heir has used it for the purposes of business and he is the owner of this asset. Whether the probate was procured or not is something which is not relevant in my mind, for the reason that on death of his father, under a valid will which is not challenged, he had received the property. He was in domain and control of the property, and therefore in that way of the matter he was entitled to depreciation, provided he had used it for the purposes of business, which he has used. So what is his crime? His crime is limited to not having claimed the depreciation. The query suggests that should he be advised to revise his return of income? Why not, if it is so permissible? But should you necessarily ask him to revise the return? I would say no, for the reason that there is a provision in the form of explanation 5 to section 32, which provides that even where you have not claimed a depreciation, it will be deemed to have been claimed and allowed to you, and your actual cost would be reduced to that extent. If that is so, it is an asset which otherwise enters into block of asset, and on sale of it, if he is purchasing another asset by the year end, then in that case, whatever is the amount reinvested, he will be entitled to claim the set-off of the capital deemed short-term capital gain against the investment. The next aspect of that is, it is in respect of factory premises. Here the facts are twisted and different. Here also he has received it on father's death by succession under a will, but his ownership is restricted to 1/3. The remaining 2/3 is owned by his two brothers. Now this is a case wherein the legal heir is not using it for the purposes of his business. He has not, therefore naturally not claimed any depreciation also with respect to it. But we are told that he has allowed the use of his 1/3 share by his brother for the purposes of their business. By his brothers for the purposes of their business. Who surely would have claimed depreciation in respect of 2/3 of share. The issue which is sought to be examined here is that therefore, because his brothers have claimed depreciation, would his case also be governed by the provisions of section 50, and therefore in his case his capital gains would be considered to be hit by section 50. In this case he doesn't want to reinvest. His fear is that would he be grabbed, or would his case be covered by the issue of deemed short-term capital gain? I would believe not. Please look into this old decision of the Bombay Tribunal, which says that in this Rohita Subramanian's cases, what is essential for attracting section 50 is that the assessee who has transferred the asset should have claimed the depreciation, which in his case, neither he has claimed depreciation, nor is there a mandatory deeming provision similar to explanation 5, which deems that he has claimed depreciation. In such circumstances, I would believe that yes, that he has to not to fear the issue of deemed short-term capital gain. The last issue is that in his case, what would be in respect of 50, in respect of factory premises, what would be his cost of acquisition and what would be his period of holding. Obviously, his father has claimed a huge depreciation in respect of these factory premises. But relying on section 49(1), he wants to take the historical cost of acquisition, which I would believe would be the purchase cost of acquisition, not substituting the WDV for the actual cost in the hands of the father. As one would look at it is, and as one would apply Rohita Subramanian's cases, that you will have to harmoniously construct all the provisions of the Act. And there is nothing in 49(1) which takes you back to WDV, but it permits you to substitute the historical cost of. And if you agree with that, then the issue that remains to be examined is to subsection 42A. What is the period of holding? Even in case of depreciable assets, it is nobody's case, certainly not revenue's case, that you should treat these as a short-term capital asset. It would go back to the year of acquisition by the father, which is otherwise a concluded fact. Well, thank you so much. I believe that within the time permitted, we have completed. Thank you very much.
Thank you very much, Mr. Ganesh and Mr. Pradip. Friends, you will all agree, now a pleasant task of vote of thanks. Friends, you will all agree with me that both the brain trustees have answered all the questions to our full satisfaction. The amount of preparation they have made, one in the form of PowerPoint and another I was witnessing in the form of the notes prepared by Mr. Ganesh, was tremendous. It is, friends, as far as Mr. Ganesh is concerned, a senior Supreme Court lawyer, extremely busy schedule, but still he has acceded to our request and came to our chamber for the first time to the professional organization. I carry vote of thanks from bottom of my heart and once again request you to thank him. As far